It is February 25th, 2026. And let's just run a quick mental simulation to start things off today.
Okay, I'm game.
So you were scanning the terminal, and you're looking for the single most asymmetric trade of the decade. You want something with that explosive tech-like upside.
Right, but you probably don't want to pay 50 times earnings for a chip stock that's already priced for absolute perfection.
Exactly. So you're probably looking for, I don't know, a flying car startup or maybe some obscure quantum computing play.
Yeah.
But if we follow the smart money flows from just this past week, the hottest ticket in town isn't silicon at all.
No, it's copper. It's concrete.
Yeah, it's the sector famously derided as the widow and orphan trade. The stuff your grandmother buys because she likes the quarterly dividend check.
We are talking about the humble, dusty, heavily regulated U.S. electric grid.
Which sounds completely wild.
Yeah.
But welcome to today's deep dive. We are unpacking a massive new report from Nexus Finance that just dropped a few days ago on February 21st. And this analysis completely flips that boring narrative on its head.
It really does, because the headline they are pushing is essentially that the boring grid just became the most exciting trade of the entire decade. And to be clear, they are not talking about 4% dividend yields here.
No, they are pointing to a massive structural mispricing. So the mission of our deep dive today is to dissect exactly why the electricity grid has morphed from this sleepy utility into the single tightest bottleneck in the global AI arms race.
And crucially, why the options market hasn't caught on yet. They are still pricing these utility stocks like it's 2015.
It's a classic lag in market perception. But before we get into the actual trade mechanics, which are honestly fascinating, we need to set the macro stage. Because it's early 2026, and we're seeing a collision of three massive forces right now.
Yeah, historically speaking, these three things almost never happen at the exact same time. It's a bit of a unicorn setup.
Break those down for us.
So first, you have this staggering AI-driven power demand shock, which we will definitely get into. Second, you have a multi-trillion-dollar infrastructure supercycle happening.
Right, the reshoring, new factories, the chip fabs being built.
Exactly. And third, and this is the kicker, we are currently in a rate-cutting environment.
Which is the true anomaly here. Usually if you have a massive industrial boom going on, the Fed is hiking rates to cool things down.
Right, to prevent inflation from running hot.
But right now we have the accelerator pressed firmly to the floor on the demand side, and the Fed is actually easing off the brake on the cost of capital.
And that specific combination creates a truly frantic environment. I mean, to understand the stakes, you don't even really need to look at the data yet. You just need to look at that quote from Elon Musk that Nexus highlights right at the beginning of their report.
Oh, I know the exact one. Let me pull it up. He said, quote, billions of dollars of the most advanced hardware sitting dark because there's not enough electricity to run them.
Just think about the sheer capital destruction in that sentence.
It's insane.
You have these NVIDIA H200s, B100s, these incredibly expensive chips just depreciating in a warehouse somewhere because the local utility literally cannot hook them up to the grid.
It is the absolute definition of a hard physical constraint. So here's our roadmap for the dive today. First, we're going to break down the sheer physics of this demand shock and why the Department of Energy got their forecast so incredibly wrong.
Yeah, that's a huge piece of the puzzle.
Then we're going to look at what Nexus calls the Desperation Premium, which is showing up right now in the PJM grid auctions. And finally, we will dissect the specific financial instrument Nexus is pitching, the XLU LEAPS.
The Greeks on that specific trade look incredibly juicy right now.
It is all about the convexity.
Yeah.
Okay, so let's start with this demand shock.
Sure.
I think anyone listening to this deep dive already knows the basic trope. AI needs power.
Right, it's old news.
But the scale that Nexus Finance is talking about here is completely different. They are projecting that by 2028, AI data centers are going to consume nearly 25% of all U.S. electricity generation.
25%. That number just stops you right in your tracks.
It does, because for context, Nexus points out that the entire residential sector of the United States,
Every single home?
every toaster, every Tesla charger in the garage, every HVAC unit, every television in the country combined, only consumes about 38% of the grid.
So in a span of just about 4 years, one single industry, AI compute, is going to rival the power consumption of every household in America combined.
And the grid is an incredibly slow-moving beast. Historically, it grows by what, maybe 0.5% a year?
If that.
So how did the official forecasts miss a jump of this magnitude? The Department of Energy employs some brilliant modelers. How did they not see 25% coming?
Well, they were modeling for the wrong phase of AI, and the Nexus report points this out brilliantly. All the early models were built around training clusters.
Okay, so teaching the AI to be smart in the first place.
Right. And training takes a massive amount of power, but it's sporadic. You build a data center, you train a massive frontier model for maybe 3 to 6 months, and then the run is done. You stop.
But we've moved completely past just training now. We're deep into the deployment phase.
Exactly. Nexus calls it the inference explosion.
Inference being when the model is actually out in the world working?
Yes. Answering queries, writing code, generating video for millions of users 24/7. The analogy I like is that training is like building a car engine in a factory. It takes a lot of energy to build it once.
Sure.
But inference is taking that car and driving it at 100 miles per hour forever without ever turning it off.
And right now, every major enterprise on the planet is spinning up these inference workloads simultaneously.
Simultaneous and permanent baseload. That is exactly what the models missed. They didn't anticipate that Google, Meta, Microsoft, Oracle, and Amazon would all decide to CapEx the equivalent of the Apollo program at the exact same moment.
And speaking of CapEx, the dollar figure in the report is just staggering. It's $1.2 trillion.
$1.2 trillion in annual capital expenditure by the hyperscalers by 2028.
It's honestly a number that's hard to even visualize. I mean,
Right.
spending that in a single year that is larger than the entire GDP of Saudi Arabia. It's larger than Switzerland.
And here's the kicker with all that spending. Almost every single dollar of that 1.2 trillion is effectively a derivative debt on electricity.
How so?
Because you cannot spend that money on server racks if you don't have the juice to plug them into. The hardware is completely useless without the electrons.
So the bottleneck of the whole tech industry is completely shifted. 2 years ago, the bottleneck was TSMC. Could they print enough silicon chips?
Right. Everyone was tracking wafer yields.
But now, the chips are just piling up on the loading docks. The new bottleneck is the physical wire.
Exactly. It's watts. The report makes it clear watts are the new gold.
It's not just the chips themselves, right? It's the cooling. The report dives into these PUE ratios.
Power usage effectiveness. Yeah, GPUs run incredibly hot. For every watt of actual computing power you use, you need another 1.2 to 1.5 watts just to keep the facility from melting down.
Which leads us directly to the concept of the Desperation Premium. This is where the macro theory of power demand hits the harsh reality of the actual marketplace. Nexus highlights these recent auction results from PJM Interconnection.
Yeah, this was the massive wake-up call for the entire industry. For listeners who don't track the grid, PJM manages the electricity flow for 13 states.
Including Virginia, which is crucial.
Highly crucial. Northern Virginia is known as Data Center Alley. Roughly 70% of the world's entire internet traffic flows through there.
The absolute belly of the beast.
So PJM holds these forward capacity auctions to ensure there is enough power available for future years. And in the previous auction cycle, the price for capacity was hovering around $29 per megawatt day.
The report lists it at $28.92 to be precise, which sounds pretty cheap.
It was dirt cheap. But then the inference explosion hit the market. In the very next auction that Nexus cites, which covers the 2025 to 2026 delivery year, that exact same capacity cleared at $329.17.
That is a jump of over 1,000%.
Over a 10x increase in a single auction cycle.
Wow.
And look, that isn't normal inflation. That is panic.
Yeah.
That price is a blaring siren signaling that there is physically not enough reliable, dispatchable power on the grid to meet the tech company's obligations.
But let me play devil's advocate for just a second here. If power is that expensive, why can't a company like Amazon or Google just buy 1,000 acres of desert, slap solar panels everywhere, and call it a day? Why are they so desperate for actual grid capacity?
It all comes down to the 5 nines of reliability.
99.999% uptime.
Exactly. You simply cannot run a trillion parameter AI model on intermittent power. If a cloud passes over your dedicated solar farm and the voltage drops for even a millisecond, the entire training run crashes.
And you lose millions of dollars of compute time.
Right. So they absolutely require baseload power. They need nuclear, they need natural gas, or they need massive, massive grid-scale battery storage. And they need it right now. They can't wait.
And since you obviously can't permit and build a brand new nuclear plant in 18 months,
you have to bid up the existing electrons, you have to pay to cut the line, hence the Desperation Premium.
So we have this historic supply and demand imbalance that makes the 1970s oil crisis look highly manageable. But typically, when someone pitches a utility stock trade to you, the immediate pushback from the market is about interest rates.
Right, because utilities are traditional bond proxies.
Exactly. If interest rates are high, utility stocks usually get crushed. Because why buy a risky stock for a dividend when you can just get 5% risk-free from a treasury bond?
That has been the standard Wall Street playbook for 40 years. But remember that third macro force we talked about at the top of the show. We are currently in a rate-cutting cycle.
The Fed is actively easing.
Yes. So utilities are getting this massive tailwind from cheaper debt, which they desperately need, by the way, because they have to borrow billions to build all these new transmission lines.
And simultaneously, they are getting a tailwind because their dividends are becoming more attractive relative to falling bond yields. But there's a huge nuance here that the Nexus report points out. Usually when the Fed is cutting rates, it's because the broader economy is tanking.
Exactly. In a normal recession, interest rates go down, but so does overall power demand. Factories close shifts. People conserve energy at home to save money.
But AI does not care about the business cycle.
AI doesn't get laid off. These hyperscale data centers are not going to throttle down their GPUs just because the national GDP growth slowed by 0.5%.
Right.
So you get this economic perfect storm, you have the monetary easing that usually only comes with a recession, combined with the explosive demand growth of a booming economic expansion.
It is the ultimate double whammy for the sector.
And we actually have a historical precedent for this dynamic, though obviously on a much smaller scale. The Nexus report points back to the 2004 to 2007 grid modernization cycle.
Oh, I remember that era. That was post-Enron, right after that massive 2003 Northeast blackout.
Yeah, the grid was literally falling apart. And regulators finally allowed the utility companies to spend massive amounts of money to fix it.
And because utilities operate as regulated monopolies, the financial mechanics of that are totally unique. They are legally allowed to earn a guaranteed return on equity.
Usually around 9 or 10%.
Right. On every single dollar they spend on capital expenditures. It's called growing their rate base. So when they spent all that money to fix the wires in 2004, their earnings just systematically compounded.
And the utility stocks went on an absolute tear. Nexus shows they had 4 consecutive years of double-digit returns, ranging anywhere from 13% to 28% annually.
But here is the massive difference between then and now. The 2004 cycle cost absolute pennies compared to what we're seeing today. We are talking about $550 billion in hyperscaler-backed CapEx happening in 2026 alone.
So the utility rate base is going to just violently explode upwards.
Which means their guaranteed earnings explode upwards.
Exactly.
Okay, let's get into the truly actionable part of the report, the actual trade of the decade. Nexus isn't just telling us to go buy shares of Duke Energy and sit on them for 20 years, are they?
No, they are looking straight at the options market. Specifically, they are targeting XLU.
The Utilities Select Sector SPDR fund. It's the big, highly liquid ETF for the sector.
Right, and they are focusing on out-of-the-money LEAPS, APS, so long-term options contracts expiring in December 2027 or January 2028.
Okay, and for you listening who might not trade derivatives on a daily basis, let's clarify why this specific instrument is the play here. It really comes down to implied volatility, or 5.
Right. The 5E is essentially the fear gauge, or the expected movement baked into the price of the option.
And traditionally, utilities are incredibly boring. They barely move.
So the options are priced dirt cheap because the market makers do not expect any volatility. Currently, the implied volatility on XLU options is just sitting there at 14 to 16%.
Which is comatose. The report notes that's the exact same sleepy level it was at back in the early 2000s.
And that right there is the massive market inefficiency Nexus is highlighting. The market is pricing these XLU options as if it's still just a boring bond proxy. It hasn't priced in the reality that this entire sector is fundamentally transforming into a high-growth scarcity play.
It's like you're buying options on a Ferrari, but the dealer is still charging you the insurance premiums for a 1998 Honda Civic.
That's a great way to put it. You are buying what they call mispriced convexity. Because if XLU starts moving up 20% as the mainstream market wakes up to this AI power narrative,
A 5E, that volatility pricing is going to naturally spike up as well.
yes. So you get a double multiplier effect. The underlying stock goes up, and the premium multiple on the option goes up.
That brings in the gamma squeeze potential, doesn't it? If the broader market suddenly panics, realizes, oh my God, there's literally no power left, and rushes into XLU, the market makers who sold those options have to scramble to hedge their books.
Driving the stock price even higher, which drives volatility even higher. It becomes a feedback loop.
And since the trade uses LPS, these really long-term options, you actually have the time for this complex thesis to play out. You aren't sitting there sweating the daily or weekly market fluctuations.
Exactly. You are holding a long-term ticket to a structural re-rating of the entire utility sector. You have defined risk, which is just the premium you paid, with massive leveraged upside.
But let's be surgical here, because XLU is a basket ETF. It holds a bit of everything. If I want to be really aggressive with this thesis, I assume I want the specific companies that are actually selling power into those crazy $300 PJM auctions, not just the guys managing the neighborhood power lines.
That is a very critical distinction to make. In the utility world, you basically have two camps. You have the regulated utilities and you have the independent power producers, or IPPs.
So the regulated guys are your classic massive companies like Southern Company, Nextara, or Duke.
Right. Nexus refers to them as the Navy. They are slow, steady, and they have guaranteed returns. But if they happen to make too much money from a price spike, the state regulators will step in and make them refund that excess profit back to the residential customers.
So they are incredibly safe, but their absolute upside is heavily capped.
Exactly.
Then who are the pirates in this scenario?
The pirates are the IPPs. Companies like Vistra, ticker VST, or Constellation Energy, ticker CEAJE. Nexus is extremely bullish on this specific subsector.
And that's because they are unregulated, right?
Yes. They generate power and they sell it directly into the open wholesale market at market rates. If that PJM option clears at $329, Vistra pockets that entire $329.
Wow.
There is no state regulator standing over their shoulder saying, hey, that's too much profit, give it back. They capture the Desperation Premium directly to their bottom line.
And Constellation is a massive player here because they hold the nuclear fleet.
The largest carbon-free baseload power fleet in America. That is quite literally the beachfront property of the AI age.
Because if a company like Microsoft has made these massive public pledges to be carbon negative, but they also need 24/7 reliable baseload power for their data centers.
They have to call Constellation. There is virtually no one else who can provide that kind of scale cleanly.
Now, this whole dynamic feels like it goes way beyond just corporate economics, though.
Yeah.
There is a distinct layer of national security woven into this. The Nexus report touched on a very specific meeting that happened earlier this year, the quote-unquote OpenAI goes to Washington moment.
Right, and this was a pivotal moment that frankly did not get enough mainstream press. Sam Altman and the OpenAI executive team went to Congress in early 2026, and they essentially laid out a modern Cold War argument to lawmakers.
They basically said, look, if we cannot physically power these next-generation AI models on U.S. soil, China absolutely will.
Because China is currently building grid capacity and power generation at a literal wartime pace.
They are pouring concrete for new nuclear reactors and coal plants faster than a U.S. company can even file an initial environmental permit application.
Exactly. And OpenAI's argument, which is finding real bipartisan support in Washington, is that U.S. energy infrastructure is no longer just civilian infrastructure. It is now critical national security infrastructure.
Which completely changes the risk profile of this entire trade, doesn't it?
It does. It effectively puts a government put option under the entire sector. It means we are highly likely to see sweeping permitting reform, federal backstops, maybe even direct government subsidies for transmission build-outs.
Because the U.S. government simply cannot allow the electrical grid to be the reason we lose the AI race to Beijing.
Exactly. Failure is not an option at the state level.
So if you look at the board, you have this massive demand shock, you have the macro rate cut tailwind, you have severely mispriced options volatility. And on top of it all, a geopolitical safety net.
It sounds perfect.
It sounds almost too perfect, which is exactly why we need to spend some time talking about the risks here. Nexus dedicates a whole section to what could go wrong, and we need to be crystal clear with you listening.
Yeah.
Buying out of the money LEAPS is not the same thing as buying a safe treasury bond.
Not at all. Nexus calls it the zero risk. If this thesis is wrong or the timing is off, you don't just lose 10% of your portfolio, you lose 100% of the premium you paid for the options.
They can and will expire completely worthless.
Right. And the first major macro risk that could cause that is inflation.
Because if the inflation genie somehow comes back out of the bottle and the Fed is forced to stop cutting and actually hike rates back up to 6 or 7%.
The whole bond proxy trade completely collapses. XLU will tank, regardless of AI demand.
The financing costs for all that multi-trillion-dollar infrastructure would just skyrocket overnight.
Exactly. And then the second major risk is what Nexus hilariously terms geological permitting.
Meaning the U.S. bureaucracy moves as slow as tectonic plates.
Precisely. Even with all the political will in the world, Physically building a new high-voltage transmission line across 3 different states involves negotiating with thousands of private landowners.
Not to mention the environmental impact studies.
And the endless local lawsuits. NIMBYism is a powerful force. If we physically cannot build the wires fast enough, the actual volume growth of power sold is strictly capped. You simply can't sell power that you can't deliver to the customer.
What about on the technology side? Is there a risk that AI hardware just suddenly becomes vastly more efficient? I mean, think about it. The human brain runs on what, roughly 20 watts of power?
Yeah, a very small amount.
So maybe NVIDIA figures out some architectural breakthrough and suddenly they can run a GPT-7 level model on the equivalent of a AA battery.
That is the classic Jevons paradox argument. The idea that massive efficiency gains lead to less total resource consumption.
Does it hold up?
Historically, in the computing sector, no. Efficiency just induces vastly more demand. If compute becomes cheaper and requires less power per unit, we don't use less total power. We just put the compute in exponentially more places.
Right, we'll put an LLM in our cars, our refrigerators, our smart glasses.
Exactly. So the demand floor for electricity seems incredibly robust. But yes, a massive, sudden technological breakthrough in chip efficiency could at least soften the extreme slope of that demand curve.
Okay, we've covered a massive amount of ground today. From the sheer panic in the PJM pricing signals to the intricacies of the options volatility surface, if you had to distill this entire Nexus finance thesis down to a single elevator pitch for the listener, what is it?
The pitch is that we are witnessing a fundamental regime change. For 20 years, utilities were boring, sleepy income vehicles. But right now, in 2026, they have suddenly become the single scarcest resource in the most important technological arms race of our lifetime.
The bottleneck.
Yes. And while the equity market is just starting to wake up to this reality, the options market is still completely asleep at the wheel. That gap between the physical reality of the power shortage and the cheap price of the volatility is the trade.
It is the asymmetric trade of the decade.
That is the claim Nexus is making,
Yeah.
and the data makes a very compelling case.
I will leave you with one final provocative thought today, something that has honestly been nagging at me since I read that section on the Desperation Premium. We talked a lot about tech giants like Amazon and Microsoft paying massive premiums just to cut the line.
Right, aggressively bidding up the capacity in those wholesale auctions.
But if electricity truly becomes a finite, strictly auctioned resource where the absolute highest bidder always wins, we aren't just talking about a fun stock market trade anymore.
No, the real-world implications are huge.
Think about it. What happens to a legacy steel manufacturer in Ohio? Or what happens to a regular residential neighborhood in Virginia?
If they literally get priced out of the electricity market by a chatbot.
Exactly. If an electron creates $50 of economic value when it's routed into an NVIDIA H100 GPU, but it only creates 5 cents of value when it's routed into an industrial smelting plant or your living room, does the free market just blindly allocate all the available power to the AI data centers?
That is definitely the dystopian version of this thesis. If there's no regulatory intervention, we could very well see a severe bifurcation of the real economy. Power becomes a luxury good, hoarded by high-margin tech monopolies, while the traditional physical economy faces rolling brownouts.
Sorry, you can't run your dishwasher tonight, ChatGPT is currently thinking.
It sounds like a joke, but economically speaking, that is exactly where those PJM price signals are pointing right now.
It is definitely something to mull over as you plug in and charge your devices tonight. This has been The Deep Dive. Thanks for listening.
See you next time.